Welcome to The Explainer. Today, we're unpacking the global economy in 2026. Now, I know for a lot of us, macroeconomic headlines can feel, well, totally disconnected from our daily lives. Just abstract numbers on a screen, right? But the truth is, the current global economy is this deeply interconnected, incredibly fascinating ecosystem. Okay, let's dive right into this.
Seriously, think about it for a second. Why on earth does the price of a barrel of oil sitting thousands of miles away matter to your grocery bill? Why does a closed-door decision made by the Federal Reserve in Washington, D.C. instantly impact stock markets in Asia just seconds later? And how is it even possible that the tech sector is being flooded with billions of dollars in new investment, while at the exact same time, economists are ringing alarm bells about slowing global growth?
Well, the answer is actually pretty simple, but the implications are massive. It's because the modern world economy is a deeply connected, incredibly complex machine. Every single day, money, energy, goods, technology, and capital are rapidly crossing borders. The whole system is so tightly woven together that when one major gear in this machine shifts, the effects don't just stay localized. No way. They travel at lightning speed through financial markets and crash right into the real economy, directly affecting your wallet, your business, and your future.
So, to make sense of this massive machine, here's our roadmap for today. We'll start with the global economic crossroads, then move to energy, inflation, and rates, and contrast that with the AI boom. After that, we'll map out the major economic players, look at trade, debt, and assets, and finally, wrap up with what happens next.
All right, part one, the global economic crossroads, a machine caught in a tug of war.
Right now, we're in kind of a weird spot. The global economy isn't collapsing, we're definitely still growing, but we're totally caught in this macro tug of war. Because the outlook is so incredibly uncertain right now, institutional projections are completely split. You've got the IMF with this optimistic outlook predicting 3% global growth in 2026, but then you look at the World Bank and they are much more cautious. They're forecasting just 2.5% growth, warning that energy disruptions and geopolitical conflict could push global growth to its absolute weakest level since the COVID-19 pandemic. So they both agree we're growing, but the risks surrounding that growth, they have absolutely skyrocketed.
Moving on to part two, energy, inflation, and rates, the friction in the machine.
So if the global economy is this giant machine we're talking about, energy shocks are literally sand in the gears. And the biggest risk of all is the one commodity that connects the entire world, oil. Oil powers everything. We're talking aviation to agriculture and fertilizer. Because of severe geopolitical disruptions, like threats to the Strait of Hormuz, which is one of the world's most critical energy choke points, the World Bank has actually projected that Brent crude could average around $94 per barrel in 2026. When that happens, markets absolutely panic over two things. How much higher will the cost go, and how long is this disruption going to last?
Because here's the thing, when oil prices spike, it triggers a brutal, perfect storm. The domino effect is direct, and it goes like this. Higher oil prices immediately increase transport costs. Those higher costs get slapped onto your groceries and manufactured goods, causing inflation to rise. Then, central banks are forced to hike interest rates to fight off that inflation. Those higher rates put heavy pressure on the stock market, which spooks consumers into spending less, and ultimately global economic growth slows to a crawl. It's a direct, ruthless chain reaction.
And that exact chain reaction leads us straight into a policymaker's absolute worst nightmare: stagflation. Basically, this is a toxic combination of weak economic growth and stubborn, persistent inflation. It is literally the hardest possible environment to navigate. Why? Because if a central bank cuts rates to try and save economic growth, inflation explodes. But if they hike rates to kill off the inflation, they crush the economy in the process. You're trapped.
Speaking of rates, we really need to talk about the price of money. When central banks, and especially the U.S. Federal Reserve, decide to keep interest rates high, borrowing gets incredibly expensive across the board. We're talking about your local mortgages, small business loans, government debt, the whole shebang. And because the U.S. dollar is the world's reserve currency, when the Fed holds its rates high, it forcefully tightens financial conditions globally, for everyone.
Let's look at part three, the artificial intelligence boom, the engine of growth.
Now, while energy is dragging the economy down, we've got a massive countervailing force pushing us forward. Just look at the sheer, mind-boggling scale of the AI build-out right now. Companies are pouring billions upon billions of dollars into data centers, semiconductors, cloud computing, AI models, networking equipment, electricity infrastructure, robotics, and software. This isn't just a fleeting tech trend. This is a massive structural counterweight to all that geopolitical friction we just discussed.
So it all boils down to this crucial question. Is AI a giant bubble, or is it a genuine productivity miracle? Developing AI requires gargantuan amounts of capital and literally enough electricity to power small countries. If this technology actually delivers, dramatically increasing global productivity so we can produce way more with far fewer resources, well then it totally justifies the cost and could spark a massive global economic expansion. But if corporate earnings fall short of these astronomical expectations, markets could face a truly brutal correction. Next up, Part 4. The major economic players: US, China, and emerging markets.
These dual forces, the friction from energy and the propulsion from AI, they aren't hitting every country equally. In fact, they are creating wildly diverging realities. The US is still the primary global demand engine, and the undisputed tech hub, China, which is a massive consumer of commodities, is seeing its supply chains pivot as production shifts over to places like India and Vietnam. Meanwhile, South Asia is growing rapidly, hitting about 6.3%. But here is the really concerning part. Developing economies are struggling just to catch up, growing at only 3.6%. For countries that have to import their energy and hold their debt in US dollars, getting hit by an oil shock and high US interest rates at the same time is absolutely punishing.
Let's move to Part 5. Trade, debt, and assets. Shifting foundations.
Right beneath the surface of those headline growth and inflation numbers, the actual structural foundations of the global economy are shifting in a major way. For decades, the old model of trade was incredibly simple. Find the absolute cheapest possible supply chain. Maximizing efficiency was the only thing that mattered. But today, thanks to rising geopolitical tensions, we are moving to a totally new model, the more resilient supply chain. Companies are frantically diversifying their suppliers and moving manufacturing closer to home. Now, this resilience is definitely safer, but make no mistake, it is much more expensive. And those higher costs, they're eventually going to be passed right down to the consumer. Another foundation that's completely shifting under our feet is government debt. Following years of huge pandemic-era spending and back-to-back economic shocks, global government debt is just staggering. Now, when interest rates were near zero, this was manageable. But today, high interest rates are draining government budgets just to service the interest on that debt alone. This strictly limits what governments can actually do to help their citizens when the next inevitable economic crisis hits. Their hands are tied.
And because of all this systemic instability, non-traditional assets are being heavily monitored as vital barometers right now. Gold, for instance, is acting as a massive indicator. It tracks inflation, interest rates, the strength of the dollar, and geopolitical fear. Meanwhile, Bitcoin is being closely watched to measure global liquidity and the overall risk appetite in the market. Investors aren't just asking if these assets are going up in price, they are asking what fundamental role digital and safe haven assets are going to play in the future financial system.
Which brings us to our final section, Part 6. What happens next? The 4 scenarios.
So when we take all these conflicting forces we've discussed, the oil shocks, the massive AI boom, the high rates, and the shifting supply chains, where does the global economy actually go from here? Well, the path forward likely falls into one of these 4 scenarios. First, you've got the soft landing. This is where inflation cools off, rates finally drop, and growth stays positive. It's the optimistic route. Second, stagflation. This is where high energy costs keep inflation sticky while economic growth slows to a crawl. Third is the AI boom. In this scenario, those massive tech investments actually turn into genuine productivity gains, launching a whole new era of economic expansion. And finally, the nightmare scenario. Multiple shocks. This is where energy disruptions, trade tensions, high interest rates, and a tech correction all hit us at the exact same time, resulting in a severe global slowdown.
Now, to figure out which of those 4 futures we are actually heading toward, you don't need to track 1,000 different complex metrics. You just need to keep your eyes glued to these 10 key indicators. Watch oil prices and inflation to gauge the economic friction. Watch interest rates, the US dollar, and bond yields to understand the true cost of money. Watch gold, Bitcoin, and stock markets to read investor sentiment and fear. And finally, watch China and AI investment to see exactly where global demand and future productivity are heading.
Ultimately, the 2026 economy isn't just a simple binary story of boom or bust. It is a continuous, high-stakes tug-of-war. So the most important question I want to leave you with today is this. As these massive global forces collide, who will be crushed by the gears of this machine, and who is going to harness them to build the future? Thanks so much for joining me for this explainer. Keep learning, and I'll see you next time.